Have you ever wondered why you can't make money even though you correctly predict the market every time? The problem isn't the charts or the strategies. The problem is with you, your lack of a proper mindset. The Disciplined Trader is a classic book that says success in trading doesn't come from conquering the external world, but from conquering the internal one. If you want to cultivate a strong mind and consistency instead of just chasing money, then this video is for you. Let's begin a journey that will take you from discipline to freedom. Chapter 1, Part 1. If you're out to make money from the market but haven't understood yourself, you're not going to war with a sword, you're going with your thoughts. Trading is not a simple world. The markets don't trade based on our thoughts. What we think we see is what truly drives our entries and exits. This is why the author repeatedly emphasizes that perception is everything in trading. For example, you see a stock going up. You think it will continue to rise and you enter a trade. But did you realize it was just an illusion? Maybe the market was pausing. Maybe the smart money was exiting. However, your thoughts were what had conditioned you from the last 4 patterns, and that's what made you lose. So the first lesson is to catch the programming of your brain. Many traders think that if they master technical analysis, they will beat the market. But the truth is the opposite. Beating the market isn't as difficult as controlling your emotions. The author says that 80% of our decisions in the market come from our belief system. Now the question is, how is this belief system formed? From childhood until now, the experiences we've had, the losses we've seen, and the fears that have developed have created an inner map within us. This map tells us when to be afraid, when to be courageous, and when to retreat. But if this map is flawed, it repeatedly forces us to make the wrong decisions in trading. For instance, when you first lost money on a trade, your brain learned that the market is dangerous.
Chapter 2, Part 1. Whenever you start to panic during a trade, you should understand that you're not afraid of the market, you're afraid of yourself. In the world of trading, fear is the most traded emotion. The fear that you might lose money, the fear that you might lose what you've already earned, the fear of what you'll tell your family if you keep losing. And this fear doesn't just affect new traders, big professionals also fall victim to it. The author states that fear is not an external force, it's internal programming. Whenever you are in an uncertain situation, such as a trade with an unknown outcome, your brain takes references from old experiences. Fear is triggered from the moments where it has experienced losses, and it repeatedly tells you, don't do it, back away. Don't make that mistake again. But have you ever thought about what it means to act out of fear? Decisions made out of fear are usually extreme. You either exit without any analysis, or you double down, hoping the trade will reverse. A fearful trader follows neither a strategy nor a process. They are just seeking their own security. Now you'll ask, how do I escape this? The author's first advice is to define your risk. When you enter a trade, accept your potential loss in advance. Yes, in advance. If you're thinking of investing 1,000 rupees, mentally accept beforehand that this money is gone. Otherwise, you won't let it happen, and there's no greater loss than that. Sometimes fear arises simply because we have left infinite possibilities open. The entry isn't right, the exit isn't set, the stop loss isn't defined, and the target isn't fixed. In such an environment, the brain naturally gets anxious because there are no boundaries. So the next principle is to create a structure.
Now you're checking the charts repeatedly, reading others' opinions on Twitter, and searching on YouTube to see if your position is right. You're doing all this because you don't have faith in yourself or your system. The author says that fear is a result of you wanting to see the market's uncertainty from within yourself. You want external validation for your decisions, but the market doesn't care about your personal fears. So there is only one way to reduce fear. Separate yourself. When you judge every trade not by its outcome, but by its execution, you become a professional. Here, follow a simple rule. After every trade, don't ask yourself if you made a profit or a loss. Instead, ask, did I follow my system? If the answer is yes, then you have won, whether it's in terms of money or something else. Chapter 3, Part 1. The biggest battle in trading is not with anyone else, but with the part of you that seeks ego in every win and gets shattered in every loss. Every person has a way of thinking, a belief system, that determines how they will feel, what decisions they will make, and how they will behave in any given situation. In trading, this belief system has the most impact because everything that happens goes through the filter of your beliefs. In other words, you don't see the price action, you see what you want to see. This is why two traders can look at the same chart and arrive at two different conclusions. In this chapter, the author explains that your thoughts, your interpretations, and your perceptions, all of these together either make or break your trading. Now the question arises, how are beliefs formed? Every experience, every emotion, and every reaction gradually creates a mental framework within us. When we feel the same way in the same situation a few times, an automatic reaction starts to build within us.
Chapter 3, Part 2. Once you understand that your belief system is the root of your trading decisions, the next step is to reprogram those beliefs that repeatedly lead you to losses. And this reprogramming is not easy, because every belief is so deeply seated in your subconscious mind that it feels like the truth. For example, if you've lost money many times by entering a trending market, a belief has formed within you that jumping into the market every time it runs is dangerous. So what happens? The next time a correct breakout comes, you can't trust it because the old fear holds you back, and then you miss the opportunity. The author says this isn't a problem with your trading, it's a problem with your mental filter. And the only way to change it is to create new reference experiences. That is, to repeatedly take small trades that are according to the system, where you focus only on the process and not the outcome. Forgiveness and self-improvement. Now let's get to the final but very important part of this chapter, forgiveness. Yes, you've made many mistakes. Yes, you've made many emotional decisions. Yes, you have suffered big losses. But if you hold on to that guilt, you will never give yourself a chance to be better. Whenever you say to yourself, I shouldn't have done that, I'm so stupid, or I can't do this, you are strengthening that image in your subconscious mind, which will push you towards similar decisions in the future. This is why the author says, do something for yourself. So from today, make a rule. After every wrong decision, don't blame yourself. Instead, ask yourself a question. What can I learn from this, and what can I do differently next time? This question alone will take you from guilt to improvement. The summary of this chapter is this: your mind is your biggest market. If you understand it, rearrange it, and bind it with discipline, the external market will never be able to defeat you. Trading Psychology, Chapter 4, Part 1. To make money in trading, you don't need to know how to read charts. You need to know how to read yourself. Every time you take a trade, a silent conversation goes on inside your mind. Is this the right opportunity? Am I too late? If I lose on this, what will I do? Am I getting greedy? Am I exiting too early because of fear? This internal dialogue is the path to reaching the depths of your thoughts and neutralizing them. Because until you can recognize those conversations in your mind, you can't see the market signals clearly. This begins with self-awareness. The author says that before every trade, you should ask yourself some specific questions. These questions create mental clarity. For example, am I calm right now? Am I trading for revenge? Am I just trying to jump into the market out of boredom? If the answer to any of these is yes, then you should not take that trade. Now, you might think that so much introspection will take time and you'll miss the opportunity. But the truth is, every correct decision comes from clarity, not haste. When you plan a trade with a calm mind, the opportunity might seem a bit slower, but your execution is sharp and focused. The author calls this mindfulness in trading.
Mindfulness means being aware at every moment of what you are thinking and why you are thinking it. Risk acceptance and bias. Now let's get to a very practical topic, risk acceptance. Every time you trade, you are intentionally or unintentionally accepting a risk. But most traders accept this risk only mathematically, not emotionally. Imagine you have taken a 2% risk, but as soon as the trade goes into a loss, you become anxious. You start zooming in on the chart, panic with every tick, and want to move your stop loss. Why? Because you didn't mentally accept that loss beforehand. The author calls this partial risk acceptance, which is the most dangerous situation, because in it you are neither confident nor cautious, you are just confused. The way to escape this is to consciously feel, imagine, and accept that loss before every trade. Tell yourself, if this loss happens, I will remain mentally stable and plan the next trade according to the plan.
There is another pattern that is common among almost every new trader, the win-desire bias. As soon as you take a trade, your mind wants to win. And in that desire to win, you only look at the signals on the chart that match your hope. This confirmation bias disconnects you from the real data. The author says it's your mind that wants to, not the market. This bias strikes at objectivity. Therefore, your only responsibility in trading is to see the price as it is, not as you want it to be. For this, it is essential that you analyze the chart with evidence. Before every entry, ask yourself, is my entry signal based on data or on feeling? Is this setup defined in my system? Am I neutral about the outcome? If yes, then you are ready. Hope and consistency. Now let's talk about another dangerous trap, the hope loop. Often, after taking a trade, when the price starts to go against you, instead of taking action, you wait in the hope that the price might come back. But hope is an emotion, not a process. The author calls this death by hope. There is only one way to survive in the market: throw out hope and bring in data. A stop loss is not a suggestion, it's a limit. As soon as it's triggered, you must exit, even if the price later moves in your favor. Consistency means that you follow your rules the same way every time, regardless of the outcome. Here comes a powerful principle. If you follow your rules, you win. If you break them, you lose. This is the truth. The sooner you accept this principle, the sooner your trading will become professional. This part of the chapter tells us that real consistency is not in the charts, it's in our behavior. And the improvement in behavior begins when we start reviewing every decision with self-awareness.
Chapter 4, Part 2, Identity and Emotion Management. When a trade goes right, we start to think of ourselves as geniuses. But as soon as the trade turns against us, we feel like the market is wrong. This is the illusion that repeatedly traps every new trader. The author explains how to recognize and break this illusion by separating performance from identity. We often tie our trading performance to our identity. If we profit, we are good. If we lose, we are failures. Trading with this mindset can never be sustainable, because when you judge yourself by every result, you start making emotional decisions. This is why the author says you are not your last trade. Your last win or loss does not define you. Your discipline, consistency, and psychology are your true identity. Revenge trading and overtrading. Next, let's talk about a very subtle yet dangerous emotion, revenge trading. This happens when you can't mentally process a loss and immediately start making emotional trades to win back what you've lost. These trades aren't based on a plan, but on frustration. The author calls this an emotional hijack, where your rational mind shuts down and your survival instincts take over. There's a simple strategy to avoid revenge trading, the pause rule. Whenever you have a loss, take a mandatory 15-minute break. Don't look at any charts or think about any trades. Just step back and ask yourself, am I going to take the next trade according to my process, or am I trying to prove myself? This short pause gives you the power of self-control.
Now let's talk about overtrading. Sometimes, out of boredom or excitement, we repeatedly hit the buttons, thinking that something will just keep working. But every time you make a decision outside your system, you are weakening your muscle of discipline. Overtrading is actually a symptom of a lack of structure. The solution is to have predetermined trading hours and a maximum trade limit. For example, I will only take 3 trades a day. I will not enter after 11:30 a.m. I will not risk more than 1% of my capital on any single trade. These rules may seem boring, but they are what keep you in the long-term game. The author repeatedly emphasizes trading isn't about being right, it's about being consistent. The need to prove and letting profits run. Next, another psychological issue, the need to prove something. Many traders take risky trades simply because they want to prove to someone or to themselves that they are right. This internal pressure clouds decision-making. For example, I told my friends this stock would go up, so I will hold on to it no matter what. This isn't logic, it's ego. In trading, you don't need to prove anything to anyone. Your job is to make decisions according to your rules. Everything else is a distraction. Now, let's address the concept of letting profits run. We often get scared when we see a quick profit and exit immediately, fearing that it might reverse. But many times, the market has momentum, and we should hold our position. So, how do you decide? The author's solution is trailing stop losses and profit zones. This means that as the price moves in your favor, you adjust your stop loss, giving you both downside protection and upside opportunity. And most importantly, you should know your predetermined target zone. When you have clarity in your mind about where to exit, emotions don't interfere. So manage every profitable trade with a strategy, not with fear.
Surrendering control and the zen of trading. Finally, let's discuss the last and most profound topic of this chapter, surrendering control. Traders feel they should have everything under control, every tick, every movement, every candle. But the market is not under anyone's control. The market is random, complex, and will always surprise you. So the sooner you accept this randomness, the sooner you can start trading calmly and with focus. Surrendering control means your setup is clear, your entry and exit are predetermined, your risk is accepted, and the result is let go. The author calls this the zen of trading, where you do the work but are not attached to the outcome. This is the identity of a disciplined trader. Chapter 5, Part 1. Understanding and Overcoming Fear. As long as you are bound by unknown fears, you will see every opportunity as a threat and every threat as destruction. In this chapter, the author introduces us to the invisible thing that silently eats away at most traders' consistency: fear. Fear exists in every human. It's an emotion designed for our protection. But in trading, fear often overreacts. Fear doesn't save us from loss. It prevents us from winning. The core message hidden within fear is, you might fail. Fear comes in many forms. Fear that the trade will go wrong. Fear of what people will think. Fear of losing money. Fear of making the same mistake again. But what is the root cause of this fear? The author says fear arises when you connect the market to your identity. If you win a trade, you feel, I am right. If you lose, you feel, I am useless. This mental connection is the cause of fear. The author makes a powerful point here. Fear doesn't come from outside, it comes from inside. And until you learn to observe, understand, and let go of this fear, you will be fighting with yourself. Identifying fear and mental journaling. Now let's understand how to identify fear. When you repeatedly overthink while looking at a chart, when your stomach churns before making a decision, when you get angry as soon as a stop loss is hit, these are all symptoms of fear. There are 2 types of fear: conscious fear, which you feel, and subconscious fear,
which you don't feel but silently controls your decisions. Most traders fall prey to subconscious fear. For example, you entered a candle pattern last time and it failed. Now the same pattern forms again, but you hesitate to enter. You don't know it, but a subtle fear is at work inside that the same loss might happen again. The author calls this emotional memory override. To get rid of this, you need to neutralize your old experiences. One practice is emotion reframe journaling. Whenever there's a big loss or you fail to make a correct decision due to fear, write down the incident in detail. What you saw, what you thought, what you felt, and what you did. Then read it with objectivity, as if it's someone else's story. This will help you understand where the decision came from emotion and where it came from process. And when you observe an emotion, it begins to lose its power. FOMO and process mastery. Now let's talk about a very subtle fear, fear of missing out, or FOMO. This fear is very common when you see an opportunity passing by and you jump in without any plan. The root cause of this fear is a scarcity mindset. You feel that if you miss this opportunity, you will miss something big. But the market is infinite. Hundreds of opportunities are created and destroyed every day. The author says, FOMO is a signal that you don't trust your process. If you have a solid plan, a missed opportunity is just missed, not a loss.
Now let's discuss fear-driven mistakes. These are exiting too early, entering too late, overanalyzing, moving stop losses, increasing position size, and overcompensating for losses. The reason for all of these is one thing: fear. And the only way out is process mastery. If every one of your trading activities is tied to a checklist, fear's interference decreases because the mind needs certainty. And certainty comes from action, not from imagination. So follow a checklist before and after every trade. For example, did I identify the setup according to the plan? Was my risk defined? Did I enter with a neutral mind? Did I let go of the outcome? If the answer to all of these is yes, then you are on the path to fearless trading. This part of the chapter teaches us that you don't have to defeat fear. You have to understand and calm it down. And when your mind is calm, the market's language becomes clear. Chapter 5, Part 2. Fear and Perception Distortion. Fear doesn't just affect trading decisions. It distorts your perception. When you are afraid, you don't see the chart as it is. You start to see it as you are feeling. For example, if you are afraid of a loss, even a strong bullish candle can seem risky to you. Or if you have made a good profit, the next ordinary retracement can feel like a reversal. In essence, fear creates a lens inside you, and you filter everything through that lens. The author calls this idea emotional filtering of market data. To get out of this, you have to learn to think in a data-driven way. What the candle is saying, what the volume is confirming, what the trend is suggesting, these are important. What emotion is saying is irrelevant. Accepting randomness and loss analysis. Now let's talk about a very important concept that the author repeatedly emphasizes: randomness acceptance. When you trade with the hope of winning every time, every loss causes you emotional pain. But if you understand that trading outcomes are essentially random, you can detach yourself from the results. Your job is to create an edge, a system where you win 60% of the trades in the long run. The key to success is to apply that edge repeatedly, not to win every single trade. This is why the author says you don't need to know what will happen to make money. You just need to know what your edge is and apply it consistently.
Now, let's address the habit of giving meaning to loss. Many times, after a loss, these thoughts run through our minds. I am wrong. My method doesn't work. The problem is with me. I should give up. The author says a loss is just an outcome, meaningless in itself. The meaning you give it is what creates your psychology. So after every loss, make a habit of analyzing it. Was this according to the system? Did the market do something unusual? Did I enter emotionally? If the loss is within the system, then it's perfect. Your job is to follow the process, not the outcome. The relationship between fear and control. Here's a very important point. The relationship between fear and control. The moment you feel you can control the market, you increase your fear. Because when things go against your expectations, panic sets in. The author says, the illusion of control creates fear. Acceptance creates peace. So instead of clinging to control, you have to learn to be calm with uncertain outcomes. How do you learn this? One exercise is to take a small trade every day where the outcome is unpredictable. Just see how you feel. Write it in your journal. Then identify the beliefs hidden behind that emotion. Slowly, your mind will stop fearing uncertainty. Now for the last and most powerful concept of this chapter, respecting fear. Don't try to end fear. Listen to it, understand it, and observe it. Fear shows you your limits. When you recognize fear, it's no longer your enemy, it becomes your guide. Every time fear arises, ask yourself, what am I afraid of? Is this fear based on data or on imagination? Can my system handle this situation? With these questions, you can analyze fear instead of reacting to it. This practice slowly ends fear-based trading and begins process-based trading. And this is the true identity of a disciplined trader. Don't run from fear, learn to read it. Because when you get beyond fear, clarity, self-confidence, and consistency await you.
Chapter 6, Part 1, Expectations versus Reality. The biggest obstacle in the pursuit of consistency is our own expectations, not the market's volatility. In this chapter, the author talks about a mental trap that repeatedly deceives us in trading, the expectation versus reality conflict. Before taking every trade, we create a picture in our minds. It will work. I will make this much profit. It will rise quickly and I will exit. But the market doesn't care about your imagination. Reality often clashes with your hopes. And when this clash happens, frustration, panic, and emotional decisions begin. The author says, the more you hope for a specific outcome, the more you try to force that outcome to happen. And this is what pushes you away from your system and toward emotions. Now, let's understand how these expectations are created. Every time you make a profit on a trade, your mind wants to repeat that pattern. I made money on a breakout yesterday. I will do the same today. This is the pattern-seeking nature of the human mind. But the market is not linear. It is dynamic and constantly changing. Yesterday's pattern can fail today. Therefore, the identity of a disciplined trader is that he looks at every new trade with a fresh perspective, not with old references. The desire to be right and tracking. Now let's talk about another subtle expectation, the need to be right. When you take a trade, you internally want to be proven right. And as soon as the price starts to go against you, your ego gets hurt. You hold the position thinking that the market might come back and you will be able to prove that your analysis was correct. The author calls this ego-driven trading. This is the most dangerous place to be, where you're looking at your beliefs, not the chart. The way to escape this is to keep every trade isolated. That is, this is a new trade. It has no relation to the previous one. Its outcome does not define my worth. I will follow the process and let go of the result.